If there's one truth about money, it's this: the year goes by whether your plan exists or not. The difference between people who end 2026 calm and ahead and those who feel like money just happened to them again isn't luck or IQ. It's the number of avoidable mistakes they eliminated before January ever turned into July. This episode is the field guide I wish someone had handed me 10 years ago: what actually trips people in a modern money life, how to sidestep it, and how to swap each trap for a small ritual that compounds. No bullet points, no shame, no gimmicks. Just a smooth narrative you can copy into your calendar and your accounts so 2026 grows your wealth on purpose. Start with a mistake so common it hides in plain sight: treating money like weather instead of plumbing. When all your income lands in one big account, your brain sees a number that belongs simultaneously to the rent, the roof, this week's groceries, the 6-month car insurance, the phone bill, the annual software renewals, and the debt minimums. It calls that stew available. It isn't. Most overspenders aren't reckless, they're understructured. The antidote is choreography. Route income into a quiet staging account. On the same day each month, let automatic transfers move cash to a bills account that pays fixed costs and feeds little sinking funds for predictable irregulars like tires, holidays, and property taxes. To a sleep fund that grows until emergencies become boring. To an investing lane that buys broad, low-cost funds on a schedule, and to a weekly card that carries groceries and fuel and resets every Friday. This is not about restriction, it's about rails. Without rails, 2026 becomes 12 improvisations in a trench coat. The next mistake is underestimating how much calm costs and what it's worth. An emergency fund sounds like advice for worriers until you live a year without one. Then a flat tire turns into a finance plan at 19% APR. A sleep fund is not a moral test, it's engineering. 2 months of essentials can be enough for a dual-income household with stable work. 4 to 6 fits a one-income home or any household that sleeps better with a thicker margin. Give the account a name that makes your nervous system exhale. Keep it close enough to reach without a form and far enough that boredom can't raid it with a cap. The day you realize we can pay this once and move on is the day your brain frees up to make better money choices because it isn't on fire. Debt in a rising and falling rate world exposes the third mistake: pretending all interest is the same. Variable rate loans can feel cheap until they don't. Teaser rates expire. Buy now, pay later looks free until late fees and stacked installments sell your next month before you live it. The adult move in 2026 is to map your debt landscape like a calm accountant. For each balance, write lender, balance, rate, fixed or variable, payment, and term. Automate every minimum from the bills account so late disappears. Then choose a target and hit it on payday with an extra payment. If you're wired for math, highest APR first. If you're wired for momentum, smallest balance first. Each zero you create is a raise you route to the next target by default. If your rate is ugly and your score is decent, a fixed rate consolidation can be a bridge, if and only if you shorten the term and close the old line so you don't turn a debt problem into a lifestyle problem. The mistake isn't carrying debt, it's carrying it accidentally. People also borrow for the wrong things and congratulate themselves for the rate. A 36-month note for a reliable car you'll own for 8 years is a prepayment for sanity. An 84-month note for a status symbol turns your future into a billboard for someone else's logo. A mortgage smaller than the real estate agent thinks you can afford is a partner in your plan. A stretched mortgage is a set piece that suffocates your investing lane. The rule of 2026 is simple: match loan term to asset life and avoid paying for an object long after its usefulness ends. If you need 7 years to afford it, the object is writing your budget, not the other way around. The fourth mistake is worshiping investment novelty while ignoring contribution rhythm. People will spend weeks researching the perfect fund and then contribute sporadically, which destroys the very compounding they claim to love. Wealthy households who stay wealthy do something almost insulting to a brain hungry for drama. They buy broad, low-cost funds that own thousands of businesses. They add money on payday, they reinvest distributions, and they rebalance on their birthday and half-birthday. They keep a ballast sleeve of high-quality bonds or cash-like instruments sized to their actual feelings so that when prices drop, they don't smash the sell button. They sandbox speculation with a fixed number so fun never spills into groceries. The mistake isn't choosing the wrong fund, it's choosing a decent one and failing to fund it relentlessly. Skipping tax design is the fifth trap, and it's expensive precisely because it's boring. April isn't a season, it's a report. The design happens all year. If your employer offers a match, that's part of your pay. Collect it. If your country offers tax-advantaged accounts, wire them into the rails so contributions leave on schedule. If you're self-employed, skim a fixed percentage of every invoice into a quarterly's account the day you're paid and put due dates on your calendar with alarms that actually chirp. Ask for documentation one more time, because documentation is not busy work. It is the price of defending your choices when asked. The mistake isn't paying taxes, it's tipping through disorganization. Mistake 6 is building a life that only survives perfect months. Bills that cluster late, investments you make, if there's extra, and an income that depends on a single company that also dominates your portfolio, this is a structure that works until a Tuesday doesn't. Designed for real weeks. Put recurring bills early in the month. Schedule investments on payday before lifestyle knows the money existed. Sell concentrated company stock as it vests to avoid building a career and a portfolio on the same pillar. Keep a tiny line of credit renewed as a last-ditch shock absorber you hope never to touch. Survivability is not pessimism, it's how compounding survives your very human life. 7 is the mistake of treating your career like a commute instead of a lever. People obsess over coffee budgets and then ignore the fact that a single raise changes their math more than a year of couponing. In 2026, behave like a professional who increases price by being easier to trust. Protect 2 deep work blocks weekly and use them to produce artifacts other adults can use. A process that removes rework, a memo that clarifies a decision, a dashboard that ends a recurring argument, a demo that makes no expensive. Keep a receipts file with dollars saved, errors prevented, revenue created, days shaved. Ask for the raise or title every 9 to 12 months with those receipts in hand. If your room can't recognize value, take your receipts to another room. The mistake isn't failing to work hard, it's failing to make your value visible and tradable. 8 is mixing business and personal money until you can't tell a profit from a personality. If you have even a small side engine, open a business account, route all revenue there, pay expenses from it, and pay yourself on a schedule so the business learns to feed the household. Insure like an adult, general liability, commercial auto, workers' comp if you have people, and an umbrella policy. Document simple scopes and put quotes in writing with expiration dates. Accounts and clean books aren't just tidy, they give you prices you can trust and optionality if you ever want to sell a tidy route or a book of clients. The mistake isn't thinking you'll sort it out in April. April is too late. The attention leak that feels like personality but behaves like a bill. Doom scrolling before bed costs you sleep. Sleep loss costs you discipline. Lack of discipline costs you money in the least glamorous ways. Delivery fees, surge pricing, sloppy decisions, skipped contributions. Move shopping apps 2 screens deep and put your savings or broker app on page 1. Charge your phone outside the bedroom. Install 2 10-minute dinners you can cook when you're cooked. Walk most days. None of this is financial content. All of it is financial infrastructure. The mistake isn't believing money decisions happen only on spreadsheets. They happen in kitchens and bedtimes. 10 is buying insurance with vibes instead of math. Health coverage that matches how you actually use care. Term life if someone depends on your income. Disability insurance because your earning power is your largest asset. And an umbrella policy that sits over home and auto. This is infrastructure. Every year, review deductibles and coverage so they reflect the buffer you actually have. High deductible plans only make sense if you fund the health savings account and can cover the deductible without panic. Underinsuring feels thrifty until it costs you a decade. Overinsuring feels safe until you realize you've been paying for catastrophes you could have self-insured. The mistake is confusing fear management with risk management. 11 is housing as identity instead of as math. A home you can easily afford that leaves oxygen for investing is a partner in your plan. A stretched mortgage is a lifestyle museum that steals your future. Renting is not failure if it buys proximity, flexibility, and time to raise your price. Owning is not guaranteed wealth if the payment swallows your contributions and your repair reserve is just your credit card. In 2026, evaluate housing by asking one question. After this payment, can I still invest on schedule and sleep through a fridge malfunction? If not, the house is too loud for the life you want. 12 is using credit cards for points while carrying balances. Points can be fun, but they are never worth paying 19% APR. If you can't pay in full, a lower rate personal loan with a fixed term can be a bridge while you cut the cards off from new purchases. If you can pay in full, keep using the card as a payment tool, not a loan. Turn on auto pay in full, set alerts for big transactions, and collect rewards like a cherry on top, not as the reason you walk into the ice cream shop. The mistake is treating a convenience tool like an income source. 13 is letting subscription creep write your month. The sentence, "it's only," is the most expensive phrase in a modern household. Run a quarterly rebuy test. Would I choose this again today at this price? If the answer isn't an honest yes, cancel or pause and route the reclaimed dollars to the sleep fund or investments. If you're worried you'll lose the thread, create a single page where you note renewal dates and skim it on the first Sunday of each quarter. The difference between a plan you can keep and a plan you abandon is often 6 forgotten subscriptions and a calendar you can't see in one glance. 14 is ignoring documentation because it feels morbid. Wills, beneficiary designations, powers of attorney, and basic instructions for accounts are not for you. They're gifts for the people who will otherwise inherit a mess. Update beneficiaries after marriages, divorces, births, and deaths. Keep a simple document that says where things live. The goal isn't to contemplate worst-case scenarios, it's to be kind to your future when it's having a bad day. The mistake is thinking this is a problem for rich people. It's a problem for loved ones without a map. 15 is letting inflation and lifestyle creep team up without your consent. Prices move, so does your income, sometimes up, sometimes sideways. If you raise your contributions every time your income rises or a bill drops off, half to the future and a slice to the present, you'll look lucky in 3 years. If you let every raise turn into a subscription, you'll feel like you never catch up. Design a capture on arrival habit for windfalls and raises, a slice to the sleep fund if needed, a slice to long-term investing, a slice to any remaining ugly debt, and a slice to a memory you'll actually remember. Rules beat moods, especially in good news months. 16 is believing you need perfection. 2026 will wobble, you'll miss a transfer, you'll overspend a week. A project will explode your calendar and your plan will feel like a house of cards. The households that end the year ahead aren't the ones who never stray. They're the ones who repair fast. Never miss twice is a better religion than guilt. If you break a rule, fix the smallest thing before bed. Resume contributions next payday, trim the weekly card for a week, cancel one leak. Momentum doesn't care about your self-talk. It cares that you resumed the choreography. 17 is treating a partner like an auditor. Money shared without cadence becomes resentment with receipts. Keep it simple. 10 minutes once a week. What happened last week, what matters this week, any irregulars coming up, and one small joy you'll fund on purpose. Agree on an ask first threshold. Give each person a no questions allowance. Label accounts by job so nobody wonders whether the roof money is sitting next to the sushi money. The couples who look rich on Instagram aren't necessarily the couples who sleep well. The ones who sleep well have a calendar and a shared language that demotes drama to logistics. 18 is waiting for January to act. A Wednesday is good enough. The smallest starting line beats the perfect one. Rename one bank account Staging, Rails. Route your next paycheck there. Schedule automatic transfers to bills, sleep fund, investing, and your weekly card. Write a one-page investment policy in your own words. What you buy, how much, when you rebalance, what you'll do if prices fall 30%. Put 2 90-minute deep work blocks on your calendar this week and name the outcomes they'll produce. Send one respectful negotiation message with receipts before you sleep. Then put your phone to charge in another room. If that sounds like life advice more than finance advice, that's because money behaves better in a life that behaves. If you want to see this play out in real kitchens, picture 3 ordinary 2026 stories. A 27-year-old teacher who always felt broke installs Rails in January, seeds a tiny sleep fund by selling idle stuff, and turns on a small investment contribution she increases by $5 each month. She protects 2 deep work blocks, one for lesson planning, one for a certification that nudges her pay scale. In March, she starts a Saturday morning window cleaning route in 2 neighborhoods with a simple price book and collects reviews via a QR code. By October, the buffer is real, the card behaves, the portfolio is larger, and the side engine pays for holiday travel without debt. No heroics, just choreography.
A 38-year-old project manager drafts a written investment policy, rebalances on his birthday, sells company stock as it vests to avoid concentration, and adds a small bond sleeve so he won't panic. He moves shopping apps off his home screen, charges his phone in the kitchen, and installs 2 10-minute dinners for tired nights. He keeps a receipts file and asks for a title update in May with evidence of dollars saved and days shaved. He doesn't feel like a different person in June. In December, he does. The slope changed quietly because his weeks did. A 49-year-old caregiver chooses survivability first. They downshift housing to free cash flow, build a 4-month buffer, and tighten insurance. They create simple wills and update beneficiaries. They run a friction audit that saves hundreds per month and route the savings to the sleep fund and investments. Their portfolio is intentionally boring. Their year isn't flashy. Their stress is lower. When a family emergency hits, nothing financial breaks. That is the whole point of this work, to be strong where life is messy. The final mistake to avoid in 2026 is believing the internet's highlight reel. Most people are tired, improvising, and privately wish they have the calm you can build this year. Getting wealth right is less like a sprint and more like building a rhythm section in a band. The drums and bass play on time, and the melody on top, your goals, your treats, your trips, suddenly sounds better because the foundation is steady. Install rails, buy calm first, kill ugly interest, invest on schedule, design taxes like an adult, protect your downside, raise your price with receipts, keep a tiny engine of side income that doesn't steal your family, guard your attention, document what matters, repair quickly when you wobble, and measure progress by the slope of your net worth and the softness in your shoulders, not by a photo. If you want to end this video with something you can do in 3 minutes, write 1 sentence in your Notes app and set a reminder for payday. On payday, money moves to bills, sleep, investing, and the weekly card. Then write 4 more words you'll practice all year. Rails, receipts, rhythm, repair. Rails to move money without moods. Receipts to raise your price. Rhythm to keep promises when you're tired. Repair so a miss never becomes a spiral. That's how growth in 2026 stops being a wish and starts being a habit that pays you back every month.